shutdown in the U.S. government? That is the topic of this month's Smart Money Insights. Historically, how much has the market been down during a government shutdown? That's the question we wanted to ask. And what we found when doing our research and looking up a variety of sources was, on average, during a shutdown in the U.S. government, the market was only down about 0.94%, less than 1%. And the other question we wanted to ask is this: over the next 12 months, what did the market do after the shutdown in the U.S. government? It was actually up double digits, on average 10.77%. And take a look at this chart here provided by Vanguard. As you can see, the length of a shutdown can range from 1 day to almost a full month. But on average, as we just mentioned, the market was only down around 1% over that time. And again, a shutdown in the U.S. government is not something that has never happened before. In fact, it's happened many times over since the 70s. So let's talk about risk in your portfolio just in the midst of the volatility we've been experiencing. Really, when we talk about risk, we want to talk about three things: what you're exposed to, and that's within your portfolio as an investor; what you're comfortable taking as an investor; and then what your portfolio can actually withstand. And what we mean by that is, based on your goals, based on your retirement plan, let's say, how much can you actually afford to risk? The first discussion is around risk exposure. When we talk about risk exposure, we talk about generally two categories of risk. Systematic risk, and this is risk that includes kind of market volatility, general market risk, and it's hard to actually avoid this type of risk. The other type of risk is unsystematic risk, often referred to as diversifiable risk, and this is risk normally more associated with an individual investment. When we talk about unsystematic risk, generally there's a few subcategories, including default risk, the fear of that company defaulting on their bonds, or the stock price, of course, dropping because they're defaulting on their obligations. Interest rate risk, generally attributed to the Federal Reserve. Liquidity risk, a big one here is, the money that you need, will you be able to access it when you need it? Country risk, as I just referred to, and that's, which country are your investments actually invested in? What are the risks associated with that particular country? Specifically talking about corruption perhaps within that country, the laws and regulations of that country, and how they may prohibit you from doing certain types of business. And then finally, correlation risk. There's other risks associated with unsystematic risk, but these are some of the big ones. What are some ways you can implement to reduce systematic risk? Generally, hedging, which is normally open to more accredited investors or those who have significant assets, are able to actually participate in hedge funds. There's also hedging strategies available within mutual funds as well that are worth exploring. The other is just proper asset allocation. Being exposed to a large variety of asset classes will help reduce some of the systematic risk within your portfolio. And the ways to monitor this risk is, when you kind of look at a portfolio, check out what the standard deviation and the beta are showing for the average portfolio that you're investing into. And you can even get more granular and look at the individual investments that you are purchasing and what the standard deviation and beta is of those. And then there's other ratios that you can utilize that are really built off of standard deviation and beta that help you determine if this is a good investment. The other conversation is risk tolerance, and this is probably the most common form of risk discussion, and that's how much risk are you willing to endure. This is more the emotion side of things. And knowing how much risk you can handle is a really important factor, because it will help you reduce your chances of market timing, and that in the long run generally leads to poor long-term performance. In fact, JP Morgan did a study on this, and the average investor has an average annual return of a little less than 3%. And the reason tolerance is so important is because many times investors will take on too much risk, the market will fall, they will then panic, they will sell low, and end up then trying to get back in when the market's rebounded and gone back up. One way of determining your risk tolerance is taking a risk tolerance assessment. You can certainly find those on a variety of websites, and we have one as well that helps you determine how much risk you are comfortable stomaching within your portfolio. One thing I like to ask clients is, if you saw your portfolio down, 0%, would that be the most you'd be willing to tolerate? What about 5% if you saw it down? What would you do? Would you end up selling? Would you sell it 10% down? What about 15 or 25 or even 50%? If you were to tell me, you know what, I would absolutely start selling all of my assets at 25%, then at that point it would be a good indication that a portfolio that might be exposed to a 50% loss would not be appropriate for your investing needs. This is an example of a risk questionnaire. Margaret completed it, and it came out that her risk number was 40 out of 100, which puts her at a moderate conservative allocation. And as we can see on this chart here, moderate conservative equals about 40% stocks and 60% bonds and cash. Of course, the 40% equity is the more volatile side, and the 60% bonds and cash is the more stable side of the portfolio. The third discussion is capacity. This is how much you actually can withstand in order to reach your goals. This is, in other words, the amount of risk you need to take in order to reach your goals. And this is a little more complicated than just simply completing a risk questionnaire. It really is more doing a planning analysis where we determine what your goals are and what it takes to get there. So I generally like to look at this in the form of buckets. When you have more time on your side, your capacity is larger. The ability to take a greater risk, more room in your bucket for risk is there for those who have 20 years as opposed to 5 years. So I want to give an example. Let's say your destination is 100 miles away. Let's say you're on a road trip. GPS says it'll take 2 hours to get there at about 50 miles per hour. You, though, want to arrive in 4 hours. So from this example, it looks like you're going to be well on track. So in this case, your risk capacity is 4 hours at 25 miles per hour, but your tolerance, being that you're comfortable going the speed limit, will take 2 hours at 50 miles per hour. Technically, you could slow the car down to 25 miles an hour and arrive on time. For those who say to themselves, you know what, I know I can reach all my goals based on this risk exposure, but I want to take on more risk, they're essentially what they're doing is they're just increasing the speed of their car when they don't need to, which increases the chance that something may happen. A speeding ticket or getting into an accident in the case of the road trip, or with the portfolio would be an example of taking on too much risk and suffering significant loss as you near retirement. And as I said, you may arrive earlier by taking on more risk, but at what cost? What is it worth? But let's say the opposite is true. Well, what if your risk tolerance is less than your risk capacity? Let's say you need to arrive in 2 hours, therefore you must go 50 miles per hour to arrive on time. But you're not comfortable going over 40 miles per hour. Let's say there's a snowstorm, and so you know the roads are going to be slick. So you must make a decision. You either speed up the car and go 50 miles per hour, which is going to be an increase in risk, or you just simply plan to arrive later than you anticipated. And this is a key decision many investors have to make as they're nearing retirement. They realize they maybe didn't save enough, or they didn't take enough risk, and now they're needing to either A, step it up a little bit and take on more risk, or just simply choose to arrive late. In summary, with this presentation, I want you to really know your risk tolerance, know your risk capacity, and think long-term and stay diversified and disciplined when it comes to your portfolio. I completely understand when it comes to market volatility, how just timing this is on our emotions, but it's just so important to remember the long term, and also remember in this presentation how I talked about how the government shutdown is something that has occurred many times over, and historically during the shutdown the market was only down 1%, and more importantly over the next 12 months the market was up over double digits. And also consider rebalancing your portfolio during these times, market volatility, while the market is down 15% or so. This is a great time to actually buy when things are less expensive. My name is Josh. Thank you so much for watching this presentation. We look forward to future presentations where we talk about other key insights to investing and managing your money as smart investors. Thank you.